So in today's video, I'm going to talk about a very simple concept that if you use this and you utilize this within your trading, it will take your trading to the next level. It will give you confidence that you are on the right side of the market more often than not, and it will just give you a sense of the overall direction of price action and where the market is most likely to go. So what I'm going to talk about in today's video is weak highs, weak lows, targeted highs, targeted lows, strong highs, strong lows, everything like that. So kind of, if I just draw it out in a diagram to start off with, right, what we are looking at once we have got market structure is we've got a higher low, higher high, higher low, higher high, higher low, higher high, and so on and so forth. And this is kind of how market structure will work when you're in a bullish market. Sometimes what you might get is you might get this low, for example, and this low might put in a lower low. But there's ways and means that you can look at this and see if this is just a liquidity grab and if we're most likely to continue, in a bullish fashion. And then again, if we are in a bearish market, what we usually see is a high, a lower low, a lower high, lower low, lower high, lower low, and so on and so forth. And again, this is how market structure works, and the overall concepts of strong highs, strong lows, weak highs, weak lows is, let's just say that we're in a bearish market like on screen. What the overall idea of the lower highs is to take out the lower lows. So what we're looking at is we're looking to see a break of this low, for example. Once we get a pullback, a break of this low, and then we will get another correction, another pullback, and then the overall expectation of this high right here, is to come down and take out this weak low. So why is this low weak, you might ask? The simple reason for this low being weak is it's failed to take out this high right here. So as you will notice in a bullish market, if we're trending upwards like this low would be a strong low once it takes out this high. And the overall idea of this low is to take out the next swing high that has been created before the pullback. And that's just kind of how strong highs, strong lows, weak highs, and weak lows are formed, and that's pretty much how they work. So let's just jump onto the charts now, take a quick look at weak and strong highs and lows. So as you will notice, we will come down and we'll see if I can find a nice bit of price action, just so you get a full feel of what it's like when we're in a trending market and also in a bearish trend. So kind of around here will do, right? So if I just come back on bar replay, what we will see is we have this sort of big impulse right here. So we'll start right here, right? And then what has happened is we've put in, if I just zoom in. So what has happened is we have put in this low, right? We've got a liquidity grab below this low, and I know this because we've got a wick below. There's no body close below this, and then we've immediately retraced back into the range. And then eventually what we've done is we've come all the way back up and taken out this high. And then what this low has done, this low is now a strong low. Why? Because it's put in a new high. We then get a retrace, and then this low then becomes strong once we take out this high right here. And then again, what happens, we get a break of this high. We've got a break of this high. This low is weak because it's failed to take out this swing low right here. Some people might use this low, but again, as you can see, this high has failed to take any lows out. So what has happened is we've come down. This is a weak high, and then this low becomes strong once we get a take of this high right here. And then eventually what will happen is we will come up, and then the trend will then be exhausted, and then at some point in time what will happen is the trend will then change. And this is all depends on how you view market structure. Some people might view it as a body break, some people might use wicks, and it's all up to you and how you see the market and how you've tested and looked at it yourselves. But what we can see here is we get a break of this high, right? And you could say this is a new higher high with this wick. Some people might think this is a sweep of liquidity, and in my case I probably would. And then what this does is we then come back down. This low right here tries to put in a new high. As you can see, this high has not been breached, and then we fail to take out this high with this high. And then what happens then is we come down, we take out this low. So we take out this low right here, and then we come all the way down to here. This low then fails to create a new high. We get a retrace, and then this high right here puts in a new low, and then this high obviously now is strong. We come all the way down. This low again fails to put in a new high. This high puts in a new low, breaks this low right here. So in turn, this is a weak low, this is a strong high, And that's kind of how the market works overall, and that's how we will keep on trending until we, get a change in trend like what happened right here. So that's the overall idea of strong highs, strong lows, weak highs, weak lows, and targeted highs and targeted lows. It's a super simple concept to learn, but once you learn it, it's really good to utilize within your trading. And as you can see, obviously, once you have got this down, you will have the basic idea of market structure and the basic idea of where the market is more likely to go and which is the more high probability liquidity point to be taken out next. So it's just that simple, guys. If this video did help you out, please leave a like on today's video. If you have any questions, as always, feel free to drop them in the comments. And without further ado, guys, thank you very much for watching, and I will see you in the next one.